Namaskar. Welcome to yet another episode on Beyond Headlines. Even though nobody doubts the stability, vibrancy, and the formidable structure of India's democracy, and nobody also doubts the fact that irrespective of the government in power, irrespective of the party in power, there is a near continuity in India's economic policies and economic reforms. Despite that, surprisingly, whenever the elections are on the cards, there is a sense of uncertainty and nervousness among the foreign institutional investors, consisting of hedge funds, mutual funds, insurance funds, pension funds, etc. And because of this sense of uncertainty, it is generally noticed that they exit the market in the run up to the elections and then they come back at a time when they think is opportune. This is what we witnessed during the December 2018 quarter when the BJP lost crucial elections in state elections in Madhya Pradesh, Rajasthan and Chhattisgarh. At that time, there was a sellout by FIIs, and that kind of continued almost till mid-February 2019. Thereafter, things changed. Thereafter, FIIs have been pumping money into the Indian markets, both debt and equity. And figures say that about 48,751 crores was pumped in by FIIs into Indian debt and equity markets in March alone. At the moment, we are witnessing a bull run fueled by the FIIs, the foreign institutional investors. And the reasons for this bull run, as they say, is now as per FIIs, there is no election uncertainty because after the Balakot bombing in particular, the opinion is in the FII fraternity that the present dispensation is coming back to power. They also say that at the moment, the overall state of the economy looks nice. There is an improvement in the international trade scenario. US and China are not at such loggerheads as were expected to be. The rupee is appreciating. Commodity and oil prices have been steady. And most importantly, the FIIs are expecting a rate cut in the ensuing MPC meeting to be held on Thursday of the Reserve Bank of India. All the other negatives, because of which there was a sellout earlier, are no longer on the horizon. And those negatives were dipping corporate profits, skittish, uncertain GDP growth, household savings showing a dip, consumer spending showing a dip. A lot of those negatives are not on the cards. So at the moment, a FII-fueled rally on the Indian markets, both debt and equity. It is expected to continue right up to the elections, and thereafter, based on which party comes to power, we would come to know what is the state of the election, what is the state of the stock markets, the indices, and other markets. I have with me my dear friend Apurva Vora. Apurva, welcome to yet another episode on Beyond Headlines.
Thank you, Akhilesh.
And today we are going to talk, Apurva, foreign institutional investors.
Yes.
We first need your views on their investments in India. We'll come to the bull rally later.
So, Akhilesh, if you look at the data which we have already, this year, 2018-19, has been a year where we have seen a negative flow of the FIIs on in the entire year basis. Like what you pointed out, if you look at the last few months, there's been a major change in their outlook. But prior to that, the first 9-10 months of the year, they were certainly not so happy about India in terms of investing into India. Multiple reasons.
I'll interrupt here.
Please.
Would they be looking at India to be a risky proposition at that point of time?
To a large extent, yes, because the US-China trade war impact, our own Indian problems in terms of the oil prices moving up internationally and the effect of that in India.
Deficit was in
current account
adverse
deficit.
direction.
So all this, and on top of it, the election results that happened towards the fag end of the calendar year, all these put together, there were enough reasons for them to be slightly negative or nervous about. And I think that is something which was telling very clearly. Of course, like what you said, I agree. Last few weeks or 1.5 months or 2 months to be precise, there's been a huge change thereafter.
Yes.
And that is what we've been seeing.
So coming back to FIIs, this was this year. As you said, this was an unusual year.
This was an
where
unusual
we've had a negative inflow, or I would say an outflow at the end of the day.
Exactly.
Particularly you said on the debt front.
Agreed.
Which means it doesn't reflect on the quality of our debt paper.
Yeah, but that is exactly getting reflected of all the issues that we have seen in the last 1 year on the debt market,
Right.
starting from ILNFS to series of other things that we have seen. So there's a reason for any investor from outside to look at the country with that degree of fear, or and obviously they would not commit more money. This is exactly what we have seen.
So my first question to Apurva, how important are FIIs to Indian markets and the money that they get in?
They're very important in various ways. Now, it's very easy for any investor today to speak of and say that the domestic investors have become a formidable force and FIIs are no longer that important. But the reality is that everyone is required in the market for them to participate if we really want a sustained rally in the market. FIIs also bring in a certain degree of validation of India's economic processes and policies, and
Which
the
I
outcome,
think is more important today.
which is very important.
Yes.
So that validation from an outside is much more important to a lot of people. One more thing that we need to remember is that bulk of the FIIs are actually institutional money, which would be sovereign funds, that could also be endowment funds and all. So when those kind of money come in, they come in with long-term commitments.
So that is a better
is important.
credit rating of India
Absolutely, yes.
than even any Standard & Poor giving us a rating. But then I have a question. The prevailing perception is that Indian markets are expensive. They still commit funds at a time when they think the Indian markets are expensive, or do you think Indian markets are not expensive? What's your view on this?
So Indian markets are marginally expensive is what I would say.
Okay.
But having said this, their outlook towards the market when they invest is not necessarily very short term. One. Second thing is, a lot of investors from outside will actually look at plus or minus their weightages or country weightages in their global allocations. So it is more to do with allocations. Now, despite allocations, you may take a call, strategic call, and say that this year we would go slow, or this year we will have an accelerated investments into India. That can happen. But having said this, the data actually suggests that except for this year, they've actually been quite bullish in India over a long period of time.
I have a question to you which has to do with the fact that you said that their viewpoint on the economy or their investment duration is generally not for short duration. But then don't you think when they exit because of political uncertainty, it's like at that point of time giving preference to sentiment which could be very short run?
They would be merciless investors, let me put it this way. We domestic investors have shown a lot of resilience of late, but of late whatever has happened is largely because of what is looking as a very small thing, what we call systematic investment plans, or the domestic flows coming into the market. Now that is good sustaining stuff. For a foreigner who is coming into India, can take a very tactical call, and if they are not very comfortable, they could be quick in terms of taking their calls. So the long-term sticky money will stay, but the short-term part of the money, and you will always have two buckets. The short-term part of the money could react very, very quickly in terms of the exit.
Oh, so their entry and exit could be
fast.
Very, very
Yes.
short. I have a question on this. You had mentioned country allocations.
Yes.
Why does China score over India in terms of country allocations? We recently saw the MSCI index in which the China weightage has been, increased.
Yes.
India has been downgraded in terms of the allocation. Why is China, I believe that we have a far more transparent market comparatively related to China, but then China scores. So what is the reason?
We actually lack the kind of depth which China can offer.
Oh.
The largest market cap company in India would be no match to the top 10 in China. So the reality is that Indian markets do not offer that kind of depth. And in absence of that kind of depth, it is obvious that the money will flow into a market which is a lot more robust enough in terms of absorbing that quantum of money.
So we are talking about depth
Much
of
larger.
market capitalization.
Absolutely.
I do remember reading a report recently that Tencent, the Chinese
Yes,
giant,
exactly.
was the first Asian company to cross $500 billion of market capitalization.
Yes.
I don't think any Indian company is in the running for it.
Yeah.
So it is a depth finally that attracts them
Absolutely.
to China. It gives them a bigger capacity to invest, and the Chinese entity has a bigger capacity to absorb.
Yes, absolutely correct. I have to admit this.
So
quickly.
when does India reach something like that?
Oh, still some time away. I think let's enjoy the journey till that time is what we keep on saying.
I like that.
We're still far away.
That gets me another question. Does India really compete with China, or do we have other competitors in the allocation basket of a foreign investor?
See, in our interactions with a lot of people and even some of the overseas investors, in India we seem to be obsessed with comparisons with China. when you interact with Chinese, they don't consider India as a competition only. Let's face this reality. It's always good to benchmark against somebody who is very large, and I think that's what we are doing. Nothing wrong in doing that.
Right.
But China is a much larger economy, has much larger depth as well. So if we compare ourselves with China, that would not be a right comparison. That is a larger economy than India today. The previous question that you had, I think, is more relevant. When do we reach there? Maybe a decade away or maybe a little more. But as long as we continue to do well as an economy, the flow and the divergence between India and China will get narrowed, and we should be feeling happy as long as we see that trajectory happening.
Talking of comparisons, even though this doesn't hold any water as far as India is concerned, but I was reading a report where Pakistan had been upgraded into emerging market status, and within the shortest possible time, probably they are going to be downgraded out of it because their capital markets lack any kind of a depth.
Absolutely.
So I think depth really matters more than transparency and regulation.
It does.
The capacity to absorb.
Absolutely.
So over your career of consulting, Apurva, I have a question. I think we are seeing a situation where the volume of the domestic investors, the DII as we call it, has now overshot the FIIs.
Yes.
In other words, the ability of the FIIs to probably, manipulate or influence the direction of the market, I think has receded over the years.
True. We would immediately agree on this part that the FII influence on the markets in general is much lesser than what we had seen about 4 or 5 years back. And a lot of things have happened in between. Most important thing is that some of the institutional money that has started coming into Indian market and EPFO money as well, that has given a certain degree of stability in the market. There is a constant flow of that pension money, which now keeps the market in a much better shape. Gone are the days where FII exits would really mean that much of panic to an Indian investor. Yes, it does impact. It does impact the market cap. It does impact my NAV as well. Everything is fine. But is it going to impact significantly? Probably the answer is no now.
So, in terms of impact, this is a bull run.
Yes.
People say funded because of the FII coming into large numbers suddenly. How long you think this is going to run? Is it going to end at the time of the election results?
So that would be the first trigger for someone to be watchful about. Till election, it looks to be a smooth ride. Thereafter, depending upon how the outcome of election comes in and what kind of seat share that happens thereafter, will decide a lot of stuff. But that's more sentimental in nature. We've said this even before that it's the corporate earnings which will eventually take over everything.
I was going to come to that question to you, Apurva. I might interrupt you now itself.
Please.
Between sentiments and corporate earnings, in the short run as well as long run, I mean, you as an advisor, you would obviously have an inclination towards corporate earnings because that gives you lesser risk in investment.
Agreed.
But how are FIIs guided?
So FIIs don't think really very differently, except for the fact that a short-term sentiment will not really make a big trigger for them to invest in. Structural changes they will certainly have. But then there are a lot of other factors also that play. And I'll give an example. A couple of years back, when US was downgraded, the first reaction was that if US is downgraded, possibly the allocation to other countries in good, solid economy like India will increase. Actually, the reverse happened. Because the average investor there started thinking about it as if US is not AAA, then there is no country in the world which is safe. So actually that brought to a home bias and the money went back to US
markets.
Now, these are things which normal psychology will not tell you that this is logical or illogical, but that's how it works. I think going by that, FIIs or any overseas investor will certainly have a home bias also as one of the factors. For them, India or China, they have to look at sentiments also of so many countries at a time, that it will be a movement a little bit here and there. It's not going to make a significant difference. Short-term traders, hedge funds, they might take positions, they might exit out very quickly. They might not even wait till the formation of the new government. They could be having a trigger immediately on results.
So if the results don't meet their expectation, it could be just a flight out.
Yes, anything can happen, of course.
So on this, I had another question. Apart from the US, which I believe has got the US FIIs, which I believe have a sizable exposure to India, which are the other countries which have a sizable exposure, their FIIs?
So typically US, Luxembourg, Singapore, these are the, and Mauritius. But Mauritius, we've seen a steady decline in terms of money coming via the Mauritius route. But typically these 4-5 countries would be maximum in terms of their allocation to India. US continues to be above 30% of allocation to India in that sense for a very, very long time.
And what about, Chinese funds wanting to come into India?
That is a new phenomena. In the last couple of years, we've seen a lot of interest by Chinese to invest in India. And possibly, it looks like an overstatement, but in the next 5 years, we will see a lot of influx coming into this. We are already seeing their interest into a lot of other businesses, including wealth management, which gives an indication that they have a lot of interest in India in the couple of years now.
So, would that mean that China as a market had matured and India is now in flavor?
China as a market has matured. They have now started looking at diversification beyond their own geographies. And when they look at various countries, they feel a little more comfortable about allocations to India is what we can make a conclusion, yes.
Apurva, there's one point that we need to discuss which is very interesting. In the 2004 elections, when the NDA was, India shining,
yes.
At that point of time, FIIs as well as the domestic investors, as well as the Sata Bazaar, all had factored in an NDA victory.
Yes.
And that did not happen.
Agreed.
Okay. If we talk about the present moment, all three have converged again.
Yes.
Sata Bazaar, FIIs and DIIs,
True.
they're all expecting the same dispensation to come back.
Agreed.
What if it doesn't come back? Are we expecting a market collapse?
Then it's a repeat of 2004, of course. Right? Because if the markets have factored in a victory, a Modi victory here, and with this convergence, and if that doesn't happen, then at least for a reasonably good time till there is some stability seen. And it all depends upon which kind of government then comes in power. But yes, the first reaction would be of panic for sure.
Oh, so if we get instead of fractured coalition,
Yes.
a coalition which is beyond any kind of an ideology that might really stick
Absolutely.
together, then you would be expecting the markets receding to that extent.
And all the more importantly, because we are seeing a bull run right now, that downturn could be steep and could be deep as well.
Right. So here we are discussing the FII bull run at the moment. A bull run funded primarily because foreign institutional investors have come to a conclusion at the moment that the existing dispensation, the Bharatiya Janata Party, comes back. It looks good and it is expected to continue till the election results are out. But if the election results do not match the expectations of the FIIs, then you're talking about at least a short-term, I wouldn't call it a collapse, but a significant receding in the market because the FIIs, which came in with a short-term perspective, would also get out very, very quickly. And if that happens, if in the situation where their expectations are belied, then we are talking about the market getting into a bearish mode. At that point of time, let's see what is the overall investment strategy of the DIIs, the FIIs, and the SITA market too.
Yes. But there is another very interesting observation. While a lot of people have factored in Modi victory and all, we also need to remember FIIs, and this is another classic case where FIIs think slightly differently. If I look at the best 5 years on a rolling return basis or rolling investment basis, it is very interesting. But the maximum investment in India came about from 2009 to 2014 on a rolling basis. Maximum FII money has come in during that period. Yes, 1 year which was the best was for the Modi victory, but the next year thereafter we had seen negative flows again. On a 5-year rolling basis, this is not the NDA government which has seen that kind of an inflow. It is the UPA last term, which a lot of people criticize for inaction and all, has seen the maximum money coming in. But that's another interesting observation.
Interestingly, with this observation, Apurva, this bull run has ensured that financial year 18-19 ends with a 17% return on the Sensex, which has been the best in the last 4 years.
Agreed.
So, whether FII inflows matter or not, they do contribute to a good return on the Sensex.
Absolutely, they do.
The DIIs may be having a higher volume,
Yes.
but finally, FIIs do matter to us.
They do.
With this, it's Apurva and me signing off till we meet on another episode, another day. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.